Fixed means there is no change depending on the level of output. Whatever the level of output, the cost amount remains unchanged. So fixed cost does not change with output. Variable cost, they change with output. So that is a summary of kind of thing we will be discussing in today's session. We are going to investigate how these cost items behave in the short run and in the long run, and how different cost concepts are interrelated. So that is how we are going to discuss. That is what we are going to discuss today. So when it comes to cost, so here we talk about cost as a whole. The overall concept of cost we call it economic cost in economic analysis. Cost. Specifically, we call it economic cost. If we mention its cost, that implies economic cost. If we talk about cost, that implies economic cost. Economic cost is about the opportunity cost of all inputs. Opportunity cost of all inputs. There are two types of inputs. Some of the inputs are hired or purchased from outside parties. And the rest of the inputs are owned by the firm. Part of inputs are hired or purchased from outside parties. For example, labor. Labor does not belong to the owners of the firm. Firm has to hire laborers and even the managers. Raw materials, in most of the cases, they are not owned by the firm. So firm has to purchase raw materials from outside parties. So some examples are hired labor and raw materials purchased from outside. And the other part of inputs are owned by the firms. For example, machinery, buildings. Machines, most of the time, they are owned by the firm. Yes, of course, some part of machines may be hired, but most of the cases, machines are owned by the firm. They have been purchased by the firm itself, for themselves. And buildings, most of the time, building is constructed by themselves, so it is owned by the firm. But in this case of SAB, maybe this building hired one. This may be not belong to the CA itself. This may be a hired the rented place. So in that case, this building of CA is a part of hired or purchased inputs. If this building is owned by the CA, then it's a part of owned inputs. So some part of machinery and buildings are examples of owned resources, owned inputs. Because of hired or purchased inputs, firms incur explicit costs. Explicit costs. Because of hired or purchased inputs, firms incur explicit costs. Explicit cost means the actual costs out of their pockets. They have to pay for them. They have to actually make the payment. For laborers, they have to pay monthly wages or salaries. For raw materials, whenever they purchase raw materials, they have to make the payments for the raw material providers. So they are called explicit costs. Actually make costs out of their pockets. Accountants refer costs. They are explicit costs. The costs referred by accountants are explicit costs. So they consider about actual cost. How much of wages have been paid? How much of cost have been made for the raw materials? So accountants concern about explicit costs only. We can call explicit costs as accounting costs as well. So explicit cost, accounting cost, it means the same. It means the same thing. Because of owned resources, owned machinery, owned buildings, firms consider a cost which is implicit cost. Implicit cost. Because of owned resources, owned inputs, they consider a cost component which is implicit cost. Implicit cost is not a part of actual cost. Firms do not have to incur them in actual monetary terms. They don't have to pay for them. They don't have to actually pay for them. There won't be any cash payment. There won't be any payment through checks for owned resources. If it is owned by the firm, then there won't be any payment for another party. Yes, of course, the firms have already paid for them when they were purchased. For example, in this year, the firm owns the machine. The firm owns the machine. And they use this machine in the production process in the current year. They use this machine in the production process in the current year, let's say in 2024. But this machine was purchased in 2019. It was purchased in 2019. And they have spent 10 million rupees for that machine. Do we have to consider this 10 million as a cost in 2024? Not really, because in current year, the firm does not make any payment related to this machine purchased in 2019. If they have already made the payment for the machine in 2019, they have completed their payment in 2019, so this is already done. There is no any payment for this machine in 2014. It's completely borne by the firm in 2024. So this 10 million rupee payment made in 2019 is not a part of cost in 2024. The payment for this machine made in 2019 is not a part of cost in 2024. So this is kind of a sunk cost. Sunk costs are the cost items which have already been made. Sunk costs are costs that have already been made. So this cost of machine, which is 10 million rupees, have already been made in 2019. So it's a sunk cost. So we don't have to consider this sunk cost in decision making in 2024. This sunk cost is not considered in decision making in 2024. So in 2024, for this machine, there is no payment. There is no payment to any outside party. But the thing is, if this firm hire out this machine to an outsider, they can earn some income, some rental income. If this firm rents out this machine to an outsider, let's say this is firm 1 which owns this machine. Firm 1 rents this machine out to firm 2. Firm 1 which owns this machine rents out this machine to an outside firm which is firm 2. So as a result, firm 1 receives a rental income from firm 2. Firm 1 receives a rental income from firm 2 because firm 1 has rented out this machine to firm 2 because this machine is not currently used in the production process. So what I wanted to highlight is if an owned input is not used in the production process, the firm which owns that production input can rent them out to outside firms so that they can earn some income, rental income. So this rental income, which is possible to earn is a part of implicit cost. It's a kind of it's a type of implicit cost. This firm has foregone this rental income. This firm one has sacrificed. This firm one has foregone this rental income because they are using this machine in their production process. If they are not using this machine in the production process, they could earn this rental income. But since they are using this machine in the production process, they sacrifice this rental income. So this foregone rental income or sacrificed rental income is an implicit cost. It is an implicit cost. So it is not actually paid in cash or in check, but it's a foregone cost. It's a foregone cost. The machine is used in the production process. Yes, that's true. For that, there is no any actual payment. But the thing is, if the firm does not utilize that machine in the production process, they could rent this machine out to an outside firm, and through that they can earn a rental income. Because they are using that machine in the production process, they have foregone that income. They have sacrificed that income. This sacrificed amount of rental income is an implicit cost. So implicit costs are not actual costs made out of pocket. Instead, they are implied costs. They are implied costs. So this foregone or sacrificed rental income is an implied cost of the machine. Is an implied cost of the machine. Likewise, if the firm owns a building, the rental income foregone by that firm is a part of implicit cost. If the firm owns its own vehicles, the foregone rental income is a part of implicit cost. So implicit costs are the costs that the firms have foregone. Implicit costs are the incomes. Implicit costs are the incomes that the firm can earn. I will write it here. Implicit costs are the foregone or sacrificed income that the firm would earn by renting the owned inputs to outsiders. Because those inputs used the production process they have sacrificed so rental income. Result They are the opportunity cost. So on inputs. They are opportunity cost of on inputs. So those opportunity costs should be considered in managerial decision making. This for Professor Samantra. Finish. Okay. So explicit costs are the only costs that accountants consider. Implicit costs are not considered by accountants. Accountants do not consider implicit costs in record keeping. Explicit costs are the only costs that accountants consider. Accounting cost refers only to the firm's actual expenditures or explicit costs, and it is important for financial reporting and reporting by the firm and for tax purposes. So explicit costs are the cost items that are considered by accountants. So they are also called as let's manage this. Explicit costs are the only cost items that are considered by accountants because those are the cost items that accountants use in financial reporting and for the tax purposes. But in managerial decision making, we should consider both implicit costs and explicit costs. In managerial decision making, we should consider both implicit costs and explicit costs. So implicit costs plus explicit costs, together we call them economic costs. Together we call them economic costs. So first we will discuss short-term cost concepts. We will discuss short-term cost concept first. As I told you before, short-term costs has two components, variable costs and fixed costs. Like in the production theory, here also we assume capital is fixed and labor is variable. So because of fixed capital, we incur fixed costs. Because of variable labor, the firm incurs variable costs. So total fixed cost we abbreviate as TFC. Total variable cost we abbreviate as TVC. Total cost is the summation of TFC and TVC. Total cost is the summation of total fixed cost and total variable cost. Total fixed cost does not change with output. The total fixed cost does not change with output. Total variable cost, they change with output. Total fixed cost does not change with output. Total variable cost does change with output. Total cost is the combination of both TFC and TVC. So TC, yes, it changes with output. Total cost changes with output because total variable cost is a part of TC. Since TC is changing with output, since TVC is changing with output, TC is also changes with output. Since TVC is changing with output, TC is also changing with output. That's why we say total cost is a function of output. Total cost is a function of output. Total cost depends on output. Depends on output. Total cost is a function of output. That means total cost depends on output. When output changes, total cost also will change. Right? Because TVC is a part of total cost. Because TVC is a part of total cost. TVC is changing with the output. So since TVC, which is changing with the output, is a part of total cost. So total cost is also depends on output. So from TC, TC is the summation of TFC and TVC. So for these three cost concepts, from these three cost concepts, we derive some other cost concepts. These are the three main cost concepts. From these three main cost concepts, we derive some other cost concepts. They are average total cost, average fixed cost, average variable cost, and marginal cost. But before that, we have average total cost as well. ATC stands for average total cost. So from these three cost concepts, we derive 1, 2, 3, 4, 5 cost concepts. Average total cost, average fixed cost, average variable cost, and marginal cost. Sorry, we have only 5. Average total cost is here. Yes. So we talk about average total cost, average fixed cost, average variable cost, and marginal cost, which are calculated based on these main 3 cost concepts. These are the main 3 cost concepts. From these 3 main cost concepts, we calculate 4 other cost concepts. So what is average total cost? We calculate average total cost based on total cost. Average is something divided by output. Average is total cost divided by output. If the total cost is 10,000 and we produce 1,000 units of output, what is the average cost? 10,000 divided by 1,000, it's 10 rupees. If the total cost is 10,000 rupees and the firm produces 1,000 units of output, what is the per unit cost? What is the cost per unit? Cost per unit is 10 rupees, and that is average total cost. That is average total cost. To produce one item of output, to produce one unit of output, the firm has to bear 10 rupees. That is average total cost. And the next concept is average fixed cost. Average fixed cost we calculate by dividing total fixed cost by output. Let's say out of these 10,000 rupees, out of this 10,000 rupees, 4,000 rupees is fixed cost. Total fixed cost is 4,000 rupees, which is a part of total cost of 10,000 rupees. Then what is average fixed cost? 4,000 rupees of total fixed cost divided by 1,000 units of output. The answer is 4 rupees per unit of output. Firm bears 4 rupees for fixed inputs. Per unit of output, firm incurs 4 rupees for fixed inputs. So incurs a cost of 4 rupees. Cost of a fixed cost of 4 rupees. For fixed inputs. So out of 10,000 rupees of total cost, 4,000 rupees is total fixed cost. Then the remaining of 6,000 rupees, the remaining part of 6,000 rupees is total variable cost. From total variable cost, we calculate average variable cost. Average variable cost. Average variable cost is total variable cost divided by output. Average variable cost is total variable cost divided by output. So 6,000 divided by 100, sorry, 1,000. Value is 6. So per unit of output, per unit of output, the firm incurs variable cost of 6 rupees for variable inputs. So average costs are per unit cost. Total average cost is total cost divided by output, that is per unit total cost. Average fixed cost is total fixed cost divided by number of units produced. Then that is per unit fixed cost. Total variable cost is, average variable cost is total variable cost divided by number of units of output produced. That is per unit variable cost. So you see here is 10 rupees of total average variable cost. This 10 rupees of average variable cost equals average fixed cost of 4 rupees and average variable cost of 6 rupees. Average total cost of 10 rupees equals to average total cost of 4 rupees plus average variable cost of 6 rupees. So that's what here it mentions. Average total cost equals to average fixed cost and average variable cost. If you want, we can have a break of 5 minutes. You want a break? Or shall we continue till 3 o'clock? What do you prefer? 2 break कर देंगे, sorry, 4 break कर देंगे, then break कर देंगे, तो 5 आ गए हैं. Continue. Then this marginal cost, the next cost concept is marginal cost. We calculate it. Change in total cost. Change in total cost divided by change in output. This output is number of units produced. Output for number of units produced. That is the change in total cost. Change in total cost as a result of an increase in production by 1 unit of output. That is the change in total cost as a result of change as a result of an increase in production by 1 unit of output. So to produce 1,000 units of output, firm incurred a total cost of 10,000 rupees. To produce 1,001 units of output, that means to increase output or increase production by 1 unit of output, total cost will be 10,000 and 10,010. Produce 1,000 units of output, total cost is 10,000 rupees. To produce 10,001 units of output, total cost will be 10,010. Then what is marginal cost? What is marginal cost in this case? Change in total cost is how much? Change in total cost is 10. 10,010 minus 10,000, the change in total cost is 10. Then change in output, 10,001 minus, 1,001 minus 1,000, it's 1. So the marginal cost is 10 rupees. Marginal cost is 10 rupees. Change in total cost as a result of an increase in production by 1 unit of output. That is what do we mean by marginal cost. Marginal cost. We discussed earlier that there are 2 types of cost, fixed cost and variable cost. There are total cost comprises of 2 components, total variable cost and total fixed cost. Between these 2 cost items, which part does change with the output level? Only variable cost. Fixed cost does not change with the output. Does not change with the output, but variable cost, yes, it changes with the output. So rather than computing delta TC divided by delta Q to calculate MC, we also can calculate marginal cost by dividing total variable cost, change in total variable cost by divided by change in output. We also can calculate marginal cost by dividing change in total variable cost by change in output. So both these methods will give marginal cost. That's the answer. So marginal cost can be calculated in this way or in this way. Because cost changes only because of total variable cost, not because of total fixed cost. Because of a change in output, only total variable cost will change, not total fixed cost. Because of a change in output, here we have a change in output. Because of a change in output, only total variable cost will change, not the fixed cost. Therefore, alternatively, we can calculate marginal cost in this way: change in total variable cost divided by change in output. That also will give the same answer for marginal cost. Yes. We learned 4 cost concepts: average total cost, average fixed cost, average variable cost, and marginal cost. Then let's see how these cost concepts vary depending on the level of output. When output changes, how these cost items will change. That is what we are going to see next. So when we were drawing production curves, we put when we were drawing production curves for short run, we put labor on the horizontal axis, output on the vertical axis. When we are drawing cost concepts in short run, we put output on the horizontal axis, cost values, rupee values on the vertical axis. When we were drawing short-run production curves, we put labor here and output here. That was in production theory. In cost theory, when we are drawing short-run cost curves, we put output here and cost values or rupee values on the vertical axis. Let's draw total variable cost first. TC equals TVC plus TFC. We will draw total variable cost first. So it starts from 0. When output is 0, total variable cost is 0. When output is 0, total variable cost is 0. Initially, starts from the origin and it initially increases at a decreasing rate. Total variable cost initially increases at a decreasing rate. So you can see it increases. Yes, of course it increases, but the rate of increase decreases. The rate of increase decreases. So initially it increases at a decreasing rate. And after reaching a specific point, total variable cost starts to increase at an increasing rate. It starts to increase at an increasing rate. Initially, it increases at a decreasing rate, and then it starts to increase at an increasing rate. You can see the rate of increase is increasing. This is total variable cost. It starts from the origin, starts from zero level, because when there is no production, there is no variable cost. Fixed cost is the curve next we are going to draw. Total fixed cost. Total fixed cost. Total fixed cost does not vary, does not change with the output level. It's always fixed. Let's say the total fixed cost is 4,000 rupees. It's 4,000 rupees. So here it's 4,000. So whatever the level of production, total fixed cost does not change. Even when the production is zero, total fixed cost is there. Even when the production level is zero, total fixed cost is there. So we draw the total fixed cost curve like this. It's a horizontal line parallel to the quantity axis. It is total fixed cost. It does not change with the level of output. If the production level is 10,000, it's still 4,000. If the production level is 20,000, it's still 4,000. If the production level is 30,000, it's still 4,000. So total fixed cost does not change with the level of output. And then we are going to draw total cost. Total cost. Total cost is the summation of total variable cost and total fixed cost. So we have combined these two curves together to draw total cost. We have total fixed cost, we have total variable cost. So the combination of these two curves will be total cost. So we have this total variable cost. We have this total variable cost. At 10,000 rupees, this is total variable cost. Say 6,000. At 10,000 level of output, this is total fixed cost. This is total variable cost at 10,000 units of output. This is total fixed cost at 10,000 units of output. Then how much is total cost? 6,000 plus 4,000, 10,000. So the level will be somewhere 10,000. So you see, to draw the total cost curve, we have to shift this curve. We have to shift this total variable cost curve upward by 4,000 rupees. 4,000 rupees at each level of output. At each level of output, we have to shift this total variable cost curve by 4,000 at each level of output. So it will be like this. So the difference between, this is total cost curve. The difference between total cost curve and the vertical difference. The vertical difference between total variable cost and total cost curve will be total fixed cost. This vertical difference at 20,000 units of output, this vertical difference between total cost and total variable cost is total fixed cost. So at zero level of output, the vertical difference between total cost and total variable cost is total fixed cost, which is 4,000 rupees. So at each level of output, we have to shift total variable cost upward by the amount of total fixed cost. Then we get the total cost curve. The vertical difference between total cost curve and the total variable cost curve is the total fixed cost. It also has the same nature, the same behavior as the total variable cost. Initially, it increases at a decreasing rate. And reaches this point parallel to the total variable cost. And after reaching that point, it starts to increase at an increasing rate. So this is how total fixed cost, total variable cost, and total cost behave in the short run. Okay. Now we will derive average fixed cost, average variable cost, and average total cost based on these curves. We did similar thing in production theory also. Can you remember? We calculated average product of labor in short-term production theory. How we did that? We drew straight lines from the origin. And then we measured the slope of these straight lines. The slope of these straight lines were average product of labor as we did in production theory. Here also to measure average fixed cost, average variable cost, and average total cost, we draw straight lines from the origin to each curve. When we draw straight lines from the origin to average fixed cost, the slope values of those straight lines will measure average fixed cost. So let's do that. So I draw straight lines to each point on average fixed cost. Like this. I draw straight lines from the origin. To each and every point, I draw straight lines. They are straight lines, okay? In my case, they don't seem like straight lines, but they should be straight lines. Straight lines. From the origin. And measure their slopes. To each and every point on total fixed cost, we draw straight lines from the origin and then measure their slopes. Those slope values become average fixed cost. These slopes become average fixed cost. Average fixed cost. What do you observe? What do you observe about the steepness of these straight lines? When output increases, what happens to these straight lines? They are getting flatter. These straight lines are getting flatter. Flatter means their slope value is reducing. These straight lines are getting flatter. They are getting flatter. That means the slope of these straight lines is reducing continuously. The slope of these straight lines is reducing continuously. The slope measures what? The slope of these straight line measures what? Average fixed cost. Average fixed cost. The slope is reducing continuously. That implies what? Average fixed cost is reducing continuously. Average fixed cost is reducing continuously. The slope of these straight lines measure average fixed cost. You can see the slope is getting reduced when we move along this quantity axis. When quantity increases, you see the slopes are getting flatter. The curves, the straight lines are getting flatter. That means their slope values are continuously reducing. The slope measures AFC. So this continuously reducing slope implies that AFC is also reducing continuously. So if we draw them in a graph, Q on the vertical axis, rupee values on the vertical, Q on the horizontal axis and rupee values on the vertical axis. If we draw average fixed cost, it looks like this. Continuously decreases. Average fixed cost is continuously decreasing. We saw that the slope of those straight lines is continuously getting flatter. That means average fixed cost is continuously decreasing. It has a hyperbolic shape. This curve has a hyperbolic shape. Has a hyperbolic shape. It never touches the quantity axis. It never touches the quantity axis. Why is that? Average fixed cost is what? Total fixed cost divided by output. Total fixed cost is always positive. Total fixed cost is always positive. Output is also always positive. So total fixed cost is always positive. Since TFC and Q both are always positive, AFC also will be always positive. Therefore, AFC will never cut the quantity axis and will never take negative values. It will never take negative values. So AFC curve will never touches the quantity axis. It will always remain as a positive value. It will always remain as a positive value without touching the quantity axis. It will never touch or it will never cut the quantity axis. If we multiply, these are AFC values, okay? AFC value and the output AFC. One, two, one. This is Q1 and the corresponding AFC value is 4. AFC 4. This is Q2. The corresponding AFC value is AFC 3. This is Q3. The corresponding AFC value is AFC 2. This is Q4. The corresponding AFC value is AFC 1. Let's give values like this is 5,000, 10,000, 15,000, and 20,000. Zero point 5, 0 point 0.2, 0.26, 0.4, 0.8. So these are the average fixed cost values correspond to these output levels. 80 cents, 40 cents, 26 cents, and 20 cents. So when we multiply this Q and AFC, we will obtain TFC. What is that? TFC. TFC at Q1 level. AFC is TFC divided by Q. We can calculate TFC by multiplying AFC by Q by using cross multiplication. By using cross multiplication, we can calculate TFC by multiplying AFC by Q. So AFC is 0.8, Q is 5,000. What is the corresponding TFC here? 4,000. When Q is 10,000, what is TFC? 10,000 multiplied by 0.4, TFC will be TFC will be 4,000. At Q 15,000, 15,000 multiplied by 0.06, 0.26, TFC will be 4,000. When output level is 20,000, 20,000 multiplied by 0.2, TFC will be 4,000. So when we multiply output level and corresponding AFC values, we always get the same answer, which is 4,000, which is total fixed cost. So that is why we call it a hyperbolic shape. It has a hyperbolic shape. The multiplication of the horizontal axis value and the corresponding vertical axis value will give the same answer. Will give the same answer, which is TFC. That kind of a shape is called a hyperbolic shape. The hyperbolic shape. TFC is always constant. Along the curve, but at different output levels, we have different AFC values. A constant value divided by different output levels. So obviously, AFC decreases when output increases. AFC is TFC divided by Q. Q is increasing, but AFC remains unchanged. TFC is remaining unchanged. So what happens? AFC continuously decreases. AFC continuously decreases. TFC remains unchanged, but Q increases. Q increases. Continuously Q increases. So as a result, what will happen is AFC will continuously decrease. AFC will continuously decrease. A constant amount divided by an increasing amount, an increasing Q amount. The answer will continuously decrease. Answer is the AFC. Next, let's draw average variable cost. So I'm drawing the graph again. Q R S. BC. Again, let's draw straight lines to PVC to calculate AVC. From the origin, I draw straight lines. What do you see? The slope is continuously decreasing. The slope value measures AVC. The slope is decreasing. So AVC is also decreasing. AVC is also decreasing. But only up to this point. Only up to this level of output. After that point, if we draw straight lines further, let's draw a straight line to this point and this point. So we can draw straight lines further because it continuously increases. EFC is continuously increasing. Then what do you see? After reaching this point, this is the straight line. This is the straight line. This is the last straight line which we can draw where average variable cost is decreased. After reaching that straight line, what happens is the slope increases. The slope increases. The straight line is getting steeper. So initially, the straight lines are getting flatter. Initially, the straight lines are getting flatter. Over this range, AVC is decreasing. And then straight lines are getting steeper. They are getting steeper. That means AVC is increasing. So after this level of output, AVC will increase. Over this range, AVC is decreasing. Over this range, AVC is increasing. So this is the flattest. This is the flattest straight line. This is the flattest straight line that we can draw to any point on PVC curve. This straight line is the flattest straight line that we can draw to any point on the TVC curve. It is flattest. It is the flattest. That means at this point, ABC is minimum. This is the flattest straight line that we can draw, and it touches the ABC curve at this point. And at that point, it represents the least slope. The least slope. Flattest means the least slope. The least slope. It is the flattest. That means it is the least slope. So since it represents the least slope at this level of output, ABC is the minimum. ABC is the minimum. So ABC curve has a shape like this. It decreases initially and reaches the point where it's minimum, and it starts to increase afterwards. It starts to increase afterwards. It decreases initially and reaches the minimum and then starts to increase. We draw a graph like this. This Q is to P values. ABC curve looks like this. And this point of Q, where ABC is minimum, is this. So don't cut the vertical axis with ABC curve, because even at the original origin point, it takes some slope. So don't cut the vertical axis by the ABC curve. Draw it without cutting the vertical axis. Okay. Keep some space with the vertical axis between the vertical axis and the ABC curve. ABC curve has a U shape. Okay. Uh, then let's grow. Average total cost. Average total cost. Again, we have to draw straight lines from the origin to the total cost curve. Draw straight lines. So up to this point, this curves are getting steeper, but getting flatter. It will be clear if I draw a different draw. Let's draw a different. TVC and TC. Is the steeper straight line. No. TVC and TC. When the Q is continuously increasing, the curves are getting more closer, but they are not intersecting. Okay, the curves are getting very much closer, but they are not touching each other. But anyhow, the vertical distance will be the same at any point of output. The vertical distance is the same. The vertical distance will remain the same. But they are not touching each other. The vertical difference, the vertical gap between TC and TVC will be the same. This is the steepest straight line. This is the steepest straight line. So at this point, at this level of output, AVC is minimum. AVC is minimum at that point. And this is the straight line that I draw, the steepest straight line. Steepest straight line that I can draw to TC. This is the steepest straight line. This is the steepest straight line to TVC. This is the steepest straight line to TC. Sorry, not steepest, the flattest. Flattest. This is the flattest straight line to TVC. That is the steepest straight line to TC. So since we have the flattest straight line to TVC at this level of output, AVC is minimum. Since we have the flattest straight line to TC at this level of output, ATC, average total cost, is minimum. Average total cost is minimum. So average variable cost minimum point is at this level of output. Average total cost minimum point is at this level of output. So average total cost reaches its minimum. Average total cost reaches its minimum after the minimum point of ABC. ATC reaches its minimum after the minimum point of ABC. What did you observe related to ABC? Before reaching its minimum, it decreases and reaches the minimum. And after reaching its minimum point, it starts to increase. The same behavior is there. The same behavior is there with ATC. It starts to increase, decrease, starts to decrease and reaches the minimum and then starts to increase So this is ABC, this is ATC. This is the minimum point of ABC. This is the minimum point of ATC. So if we go then in a graph, they look like this. ABC and ATC behave like this. As you observe in the case of ABC, initially the straight lines are getting flatter and flatter. That means ABC is initially decreasing and reaches its minimum point here. That is the point where we can draw the flattest straight line. And after that point, when we draw straight lines further, you see they are getting steeper and steeper. That means ABC is increasing. The same behavior is there with TC also. When we draw straight lines to TC, they are getting flatter and flatter. That means ATC is decreasing. And then reaches the point where we can draw the flattest straight line to TC, and that is where ATC is minimum. And after that flattest straight line, when we draw straight lines further, you see they are getting steeper and steeper. That means ATC is increasing. So here you see ABC is initially decreasing and reaches the minimum and then starts to increase. ATC also has the same behavior, initially decreasing and then start to increase. The only difference is the minimum point of ABC comes first. The minimum point of ABC comes first. And then the minimum point of ATC comes. This is the minimum point, minimum point of A, B, C. This is minimum point of A, T, C. So the minimum point of ABC comes before the minimum point of ATC. And when the ABC is minimum, when the ATC is minimum, ABC goes through that point. ABC goes through that point. ABC cuts ATC at the minimum point of ATC. ABC cuts the minimum point of, ABC cuts ATC. ABC cuts ATC at the minimum point of ATC. ABC cuts ATC at the minimum point of ATC. Then let's draw the marginal cost curve. No. MC is delta TC divided by delta Q. MC is the slope of TC or the slope of PVC. MC is the slope of TC or the slope of PVC. Because MC, marginal cost, arises only because of changes in output. Marginal cost arises only because of changes in output. So changes in output causes changes in TVC. And as a result, TC also will change. So we can either measure MC as this change in TC divided by change in Q, or else we can measure it change in TVC divided by change in Q. So how to measure a slope of a curve? How to measure a slope of a curve? To measure a slope of a curve, we draw tangent lines. We draw tangent lines. Tangent lines. So to measure MC, we can draw tangent lines either to TC or to TVC. Both will give the same results. To measure MC, we can draw tangent lines either to TC or to TVC. So let's draw tangent lines to TC. We will draw tangent lines to TC. If you draw tangent lines to TVC, you will get the same results for MC. I draw tangent lines to this point, to this point, this point, this point. What do you see? Initially, the tangent lines are getting flatter. The tangent lines are getting flatter. Tangent lines are getting flatter. And this is the flattest tangent line we can draw. After that, tangent lines are getting steeper. Initially, the tangent lines are getting flatter. This is a little bit steep, and the steepness decreases. Steepness decreases. Steepness is the minimum. That means the curve, the tangent line is the flattest at this point. After reaching this point, the tangent lines are getting steeper. The tangent lines are getting steeper. The slope of tangent lines measure MC. So since the tangent lines are getting flatter over this range, over the same range, we can say MC is declining. MC is declining. Over this range, tangent lines are getting steeper. That means over this range, marginal cost is increasing. And at this point, the tangent line is the steepest, is the flattest. That means at this point, marginal cost is minimum. Marginal cost is minimum. Initially, total cost curve is increasing at a decreasing rate up to this point. Initially, total cost curve is increasing at a decreasing up to this point. And after that point, total cost curve is increasing at an increasing rate. So the boundary is here. The boundary point is here. So that is the point where MC is minimum. TC is increasing at a decreasing point. That means MC declines and reaches this point. That is the point where MC is minimum. After that point, TC increases at an increasing rate. TC increases at an increasing rate. That is where MC is increasing. That is where MC is increasing. The same behavior of these straight lines, sorry, these tangent lines will be there with TVC as well. If we draw tangent lines to TVC, if you draw tangent lines to TVC, you will observe the same behavior. The same steepness will be there. That's why to measure MC, we can draw tangent lines either to TC or TVC. Both will give the same results. So MC behavior is like this. Q, P values. MC is the minimum point, initially decreases and reaches the minimum point and then starts to increase. Then starts to increase. I made a mistake here, sorry for that. Here, ATC doesn't cut ATC. Sorry, this point is wrong. ATC doesn't cut ATC. Please correct this graph. ATC takes U shapes and ABC doesn't cut, but it also takes the U shape. It also takes the U shape. And this gap is reducing. This gap is reducing. Initially, they have a considerable gap. They have a considerable gap. And then this gap decreases. Above we have ATC, below we have ABC. The gap is what? ATC equals AFC plus ABC. So this is ATC, this is ATC, this is ABC. And what is the difference? AFC. What is the behavior of AFC? AFC is continuously decreasing. So that is why this gap is continuously decreasing. The gap is continuously decreasing. Sorry for that mistake, it's a big mistake. I confused it with MC. ATC is taking a U shape, it takes a U shape. ABC also takes a U shape, but those two curves never touches. Those two curves never touches each other. Instead, the gap between ATC and ABC are getting decreased. The gap between ATC and ABC is getting decreased. The gap is AFC. AFC is continuously decreasing. That is why the gap is reducing. The gap is continuously reducing. The gap is continuously reducing. That is how ATC and ABC behaves. When we combine them with MC, this is MC. MC decreases first and reaches the minimum point and then starts to increase. As we saw before, this is the minimum point where MC is minimum. This is the point where MC is minimum. This is the point where ABC is minimum. This is the point where ATC is minimum. This is the point where MC is minimum. This is the point where ABC is minimum. This is the point where ATC is minimum. So they lie in this order. The minimum point of MC comes first. The minimum point of ABC comes next. The minimum point of ATC comes afterward. So if we combine ABC and ATC in this graph, this is ABC, this is ATC. This is the minimum point of ABC. This is the minimum point of ATC. the gap between ATC and ABC is getting reduced. And another important thing you can observe here is MC curve, MC cuts ABC at the minimum point of ABC. At the same time, MC cuts ATC at the minimum point of ATC. MC cuts ABC at the minimum point of ABC. MC cuts the ATC at the minimum point of ATC. This should be ATC. So how it happens? It will be clear if you look at these graphs. So this is the point. This is the point where ABC is minimum. That is the flattest tangent line, flattest straight line, flattest straight line that we can draw. If we draw a straight line to, if we draw a tangent line to the same point, if we draw a tangent line to the same point, both straight line and the tangent line lie on each other. Both the straight line and the tangent line lie on each other at this point. Straight line measures ABC, tangent line measures MC. Since the slope of both straight line and the tangent line are the same at this point, ABC and MC are equal. The straight line that we draw to this point and the tangent line that we draw to this point both lie on each other. That means their slopes are equal. Their slopes are equal. straight lines slope measures ABC, tangent lines slope measures MC. Since the slopes of both straight line and the tangent line are the same, it implies that MC and ABC are the same at this point. So this point corresponds to this output level, where MC and ABC are equal. Similarly, at this point, at this level of output, ATC is minimum. So if we draw a straight line to that point, that is the flattest straight line. That is the flattest straight line to TC. If we draw a tangent line also to that point, if we draw a tangent line to that point, both the straight line and the tangent line lie on each other. That means at that point, ATC and MC are the same. ATC equals to MC. That is the point here, correspond to this output level. So this is the typical behavior of MC, ATC, and AVC. We combine our discussion like this. The curves behave like this. So what you have to do is go home and take a piece of paper and try to understand the behaviors of these curves based on the logic I explained. If you want to measure an average value, you have to draw straight lines. If you want to measure marginal value, you have to draw tangent lines. And by drawing tangent lines and by drawing straight lines, try to draw these MC, ATC, and AVC curves by yourself. Practice it in several times. Don't try to understand these behaviors. Don't try to memorize them. It's difficult. What you have to do is just understand how they behave. In the examination also, you can take a piece of paper and draw these graphs with the understanding of how they behave by drawing tangent lines and straight lines. If you have already practiced it several times, then it is easier to remember and you can take it into a paper in the final exam. Once you draw this graph on a piece of paper, then whatever the question is asked in the examination, you can answer them easily. So initially, average total cost increases at a decreasing rate, then starts to increase at an increasing rate. That is the opposite behavior of production. Production initially increases at an increasing rate and then starts to increase at a decreasing rate. And after reaching the minimum point, it starts to decline. That is the behavior of production curve in the short run. The opposite behavior is there with cost curves. Initially increases at a decreasing rate. Increases at a decreasing rate. And then after a specific point, it starts to increase at an increasing rate. So TFC is always constant. And by combining TVC and TFC, you can join total cost curve. You can derive total cost curve. And by observing how the straight lines and how the tangent lines behave, you can easily derive MC, ATC, and ABC. But one thing you have to understand is at the minimum point of MC, that transition happens. At the minimum point of MC, that transition happens. What is the transition? The rate changes. Before the point, TBC and TC increases at a decreasing rate. And after this transition point, TBC and TC increases at an increasing rate. So that rate of change, the changing rate of change happens at these transition points. So at that transition point, MC is minimum. So clearly understand that transition point. At that transition point, MC is minimum. And after we have the minimum point of ABC, and after we have the minimum point of ATC, minimum point of ABC, and the minimum point of ATC. And the other important thing is, at the minimum point of ABC and at the minimum point of ATC, MC goes through. MC goes through there. So those are the important characteristics of this picture. We can take a break now. Come back at 5:20. It's 5:10 now. lectures currently. ඒකෙත් පළවෙනි සති 3 පැය 4යි. ඉතින් ඉක්මනින් පැය 4 කරන්න විතරයි. ඊට පස්සේ සවස් 5ක් දෙන්න කියලා. ඒක දෙක. අපි ඔරන්ට ලෙක්චර් පටන් ගන්න ඉතින් වෙලා. දැන් ලෙක්චර් කෙනෙක් හොයගෙන ඉඳලා පොඩ්ඩක් සත්‍යයක්. ඒක දුකින් සත්‍යයක්. කොයි ෂෙඩියුල් එකකින් ඉන්නේ. මිස්ටේක්ස් සති දෙකේ කන්ටෙන්ට් එක දැන් පැය 4 ඉස්සෙල්ලා තියෙනවා. terus sampai ada sesuatu yang aplikasi diutir di kamar satu paham atau satu paham andai ada satu paham yang kayak dekat tadi pasnya satu bulan kayak dekat tapi kayak dekat karena itu sama kayak tunggu hari kayak nanti pada sekarang lagi kalau mistake paling satu itu di Lanka benot itu pasti exam di ඔයගොල්ලන්ට අනිත් සබ්ජෙක්ට් මේක එකම පැරලල් යන ඒවා තියෙනවා.
ඉතින් මාකටිං එකේ අපි එක්ස්ටෙන්ෂන්ස් වලට
එක්ස්ටෙන්ෂන්ස් නේ
කැනඩි එකක්. ක්ලාස් දෙකක් තියෙනවා කැනඩි එකක් තියෙනවා CA එකක් තියෙනවා. දෙකක් තියෙනවා අපිට තියෙන සබ්ජෙක්ට්ස් ඒගොල්ලන් සමාන කරන්නේ නැහැ. ඒගොල්ලන්ගේ
සබ්ජෙක්ට් කැනඩි ජෙනරල් එක.
නෑ අපි මේ හයර් ඩිප්ලෝමා එක.
හයර්
බිස්නස් එක. අපිට සබ්ජෙක්ට්ස් හයර් කරන්න තියෙනවා. සෙකන්ඩ් එකේ සබ්ජෙක්ට්ස් හයර් කරන්න ඊට පස්සේ තර්ඩ් එකේ යනවා මේගොල්ලන්.
මේ දැන් ඔයගොල්ලෝගේ සෙකන්ඩ් ඉයර්.
මේක සෙකන්ඩ් ඉයර් සබ්ජෙක්ට්.
සෙකන්ඩ් ඉයර්. එතකොට දැන් මේ මාකටිං එකයි මේකයි විතරයි කරනම් මේ යන්නේ. මේ ටර්ම් එකේ යන්නේ.
අපිට යන්නේ මාකටිං එකයි මේකයි. දැන් අපිට මුලින්ම පටන් ගත්තේ මාකටිං විතරයි. මාකටිං විතරනේ සබ්ජෙක්ට්.
ඒ කියන්නේ මම අපිට අර විශේෂ සබ්ජෙක්ට් දෙක කියන කතාවද? මුලින්ම පටන් ගත්ත එක. ඔව් මට සබ්ජෙක්ට් දෙකකට කලින් ප්‍රොෆෙසර් අමලා පටන් ගත්තා. මට සබ්ජෙක්ට් දෙකකට කරනවා. දැන් මට අර විශේෂ සබ්ජෙක්ට් දෙක කරනවා. එතකොට අභිනමිස්ගේ එකයි මගේ එකයි කරලා යනවා. මිස්ගේ එකයි මගේ එක්සෑම් එකයි එක දවසේ හරි එක ළඟ තියෙනවා නේද? මම මිස් ජෙනිෆර්ගෙන් අහලා බලන්න. මිස් ජෙනිෆර් ගන්න කොන්ටැක්ට් කරලා මම කමියුනිකේෂන් කියන්නේ මිස් ජෙනිෆර්ගෙන් මම අහලා බලන්න කොහොමද එක්සෑම් වෙන්නේ කියලා. next week first day සතියේ මීට් එක වගේ කරමු. online technique කොහොමද කරන්නේ? එක්කෙනෙක් overseas එයාට facilitate කරන්න ඕනේ නම් ඕන වුණොත් අපිට online next quiz එකක් කරන්න. ඔයගොල්ලෝ online quiz කරලා තියෙනවද?
අපි කැලණිය නම් කැලණිය නම්
ඒක ලේබල්. ඔයාලා බලන්න මොන වගේ setting එකක්ද කරන්න පුළුවන් කියලා quiz එකක්. එන්නොත් ඉතින් අපිට ඊට පස්සේ සතිය පහ පස්සේ සතිය quiz එකක් කරනවා කියන ස්ටෙප් දාන්න ඊට පස්සේ අපි තව සමහරවිට විතර පස්සේ මේ ඉන්ඩිවිජුවල් එක්සර්සයිස් සෙක්ෂන් ගමු. අන්තිම සතියේ HP group activity එක. These are some concepts we learned in production theory. We have capital inputs, it's fixed. We have labor inputs. We increase labor input, and these are the production. That means output Q. These are average products. Average product data. Average product is total product divided by labor. And next we have marginal product. Marginal product is delta T PL divided by delta L. There is a typo error. Just correct it. It's MPL is change in total product of labor divided by change in labor. You see, marginal product is maximum here. Marginal product is maximum here. And marginal product and average product are equal here. This is where MPL is maximum. This is where MPL equals to APL. Those curves look like this. Labor on the horizontal axis, APL, MPL on the vertical axis. This is MPL. This is APL. This is where APL and MPL are equal. This is where MPL is maximum. So these curves are familiar to you from the previous session. So now we are going to link these production concepts to cost concepts. Marginal product of labor, and marginal cost of labor are related. This has an inverse U shape. As we observed before, marginal cost curve has a U shape like this. So they are related. Marginal product of labor and marginal cost marginal cost, not marginal cost, marginal cost. Marginal product of labor and marginal cost are related. On the other hand, average product of labor and average variable costs are related. Average product of labor curve looks like this. Average variable cost looks like this. So you can see these are cost curves. Sorry, these are production curves. These are cost curves. They are kind of interrelated. Their behaviors are interrelated, not their values. The values are completely different, can be completely different, but their shapes are related. This has an inverse U shape, which is MPL. MC has a U shape. This also has an inverse U shape. ABC has a U shape. And APL and MPL are equal here. At the same point, APL is maximum. In this case, you see ABC and MC are equal here, and at the same point, ABC is minimum. So you observe that these curves are interrelated. They have some relationship. So now we are going to observe those relationships with data. So can you calculate these values? The same level of capital and labor as shown here are listed in this table as well. And these are the same quantity values, output values, Q. And this is the wage rate. Wage rate. This is price of capital. Unit price of capital. Unit price of capital is R. Wage rate remains constant. R, the unit price of capital, remains constant. Calculate the variable cost. Variable cost is for the variable input. What is the variable input here? Labor. Capital is fixed. So variable cost is wage rate multiplied by labor units, number of labor units, multiply L by W. 0 into 10, 0, 1 into 10, 10, 2 into 10, 20, 3 into 10, 30, 4 into 10, 40, 5 into 10, 50, likewise 50, 70, 80, 90, 100, 110. These are the variable costs. You see, variable costs depend on the level of output. Variable cost varies. Variable cost varies depending on the level of output. That is why it's called variable cost. That was our definition. Variable cost means the cost that vary with the level of output. When output increases, you observe variable cost is also increasing. And then calculate fixed cost. Fixed cost is for the fixed input. What is the fixed input? Capital. What is the unit price of capital? R. multiply R, multiply K by R. K is number of capital units. This is unit price of capital. K into R will be the fixed cost. 8 into 20, 160. So level of capital doesn't change. R also doesn't change. So at every level of output, at each and every level of output, fixed cost remains the same, 160. And then you can easily calculate total cost. Total cost is the summation of variable cost and fixed cost. One hundred 60, 170, 180, 190, 200, 210, 220, 230, 240, 250, 260, 270. They are given here in the next slide. Okay. And if you draw them in a graph, so I did these calculations in Excel, and with the support of Excel, I drew these graphs. So they have the typical behavior as we observed in our discussion before. Initially increases at a decreasing rate, and then starts to increase at an increasing rate. So this is total cost. This is total fixed cost. This is total variable cost. And the difference between total cost and total variable cost is total fixed cost. Okay. Now we know the total cost. We know the total cost. How much they were? 160 total cost. Total cost 160, 170, 180, 190, 200, 110, 220, 230, 240, 150, 260, 270. Am I correct? Yes. So based on these total cost values, calculate variable cost, total variable cost. We calculated this before, right? Zero to 100. 0, 10, 20, 30, 40, 50, 70, 80, 90, 100, 100. Total fixed cost was 160. There is a column to mention total cost. You don't have. Yeah. Remove this. Total cost 160, 170, 180, 190, 200. Am I correct? Okay. 30. So based on these values, calculate average variable cost, average fixed cost, average total cost, and marginal cost. Take a few minutes and do the calculations. Don't take much time. And when you are writing marginal cost values, write them in between 2 points, okay? ABC and AFC, ATC values, you have to write straight. Write them straight. But marginal cost values should be in between two levels of labor. Okay, production levels. ABC is total variable cost divided by total output. Don't divide it by labor, okay? ABC is PVC divided by Q. You have to divide PVC by Q, which is TPL, not by L. AFC, you have to divide FC or TFC by Q. ATC, you have to divide total cost TC by Q. MC is change in total cost divided by change in Q. Also, you can calculate MC by changing total variable cost by changing Q. Both approaches will give the same answer. To save time, I will quickly go to the answers. A, B, C. For the first points, when output level is 0, zero divided by 0, no answer. AFC, FC divided by Q, this is Q. 160 divided by 0, no answer. ATC, TC divided by Q, 160 divided by 0, no answer. So from the next point onwards, you can do the calculations. Ten divided by 5 is 2. 160 divided by 5 it's 32. 170 divided by 5 it's 34. To calculate ATC, you don't actually have to divide TC by Q. If you take the summation of ABC and AFC, then the answer will be ATC. So you can use this approach also. Rather than calculating ATC using this formula, you can just add ABC and AFC to get ATC. And then calculate MC and mention them in between two levels of production. So change in total cost here is by 10. Change in total cost is 10. And change in output is 5. 10 divided by 5, it's 2. And next, total cost again changes by 10. And change in output is by 13. 10 divided by 13, it's 0.76. And again, total cost increases by 10. Output increases by 18. 10 divided by 18, it's 0.55. Again, total cost increases by 10. Output increases by 20. 10 divided by 20, it's 0.5. Total cost increases by 10 here. Output increases by how much? 9 or 19. 19. It's 19. 10 divided by 19, the answer is 0.52. Total cost increases by 10 again. Output increases by 15. 10 divided by 15, the answer is 0.63. Total cost increases by 10. Output increases by 8. 10 divided by 8, 0.12. Total cost increases by 10. Output increases by 6. 10 divided by 6, it's 1.16. Output increases by 10. Total cost increases by 10. Output increases by 4. 10 divided by 4, it's 2.5. Total cost increases by 10. Output increases by 2. 10 divided by 2, it's 5. Again, output increases by 10. Total cost increases by 0. 10 divided by 0, it's no answer. So you don't have to mention anything here. 10 divided by 0, it's infinity. But you don't have to mention it here. So you see cost concepts here. But do we observe? MC reaches the minimum value here. MC is minimum here. It lies between 36 and 56 of output level. ABC minimum is here. ABC minimum here. MC is minimum here. And then ATC is minimum here. That is the order we saw in the graphs. First, we have the minimum point of MC. Then we have the minimum point of ABC. Then we have the minimum point of ATC. So that order follows in our calculations as well. And another important point we observed is this is where MC and ABC are equal. MC and ABC are equal. This is where MC and ATC are equal. This is where MC and ABC are equal. This is where MC and ATC are equal. So these points have another important characteristic. What was it? Yes. MC cuts ABC at the minimum point of ABC. Implies what? At that point, MC equals ABC. And at this point, MC cuts ATC at the minimum point of ATC. In other words, at that point, MC equals ATC. MC equals ATC. So these points are observed in our calculations as well. When ABC is minimum, MC is equal to ABC. When ATC is minimum, ATC is equal to MC. Because at those points, MC cuts those points. That is what we observe. At the minimum point of ABC, MC passes through. At the minimum point of ATC, MC passes through it. Therefore, at the minimum point of ABC, MC is equal to that. At the minimum point of ATC, MC is equal to that. So these calculations are in line with our graphical representations. Then let's bring production concepts to this picture. We see the relationship between MPL and MP. As I told you earlier, MPL and MC are related. When MPL increases, MPL. When MPL increases, MC decreases. When MPL reaches the maximum point, MC reaches the minimum point. When MPL decreases, MC increases. When MPL and APL are equal, MC and ABC are equal. So let's see whether this relationship is clear from the data. Yes. When MPL increases, MC decreases. When MPL increases, MC decreases. When MPL is maximum, MC is minimum. When MPL, it should be false. When MPL falls, MC rises. MC rises. So make these corrections here. When MPL rises, MC falls. When MPL falls, MC rises. When MPL is maximum, MC is minimum. So that they have a relationship like this. Then let's observe the relationship between APL and AVC. So most of the students confuse that APL is related to AC. That is wrong, okay? APL is related to AVC, not to AC. APL is related to AT, not to ATC or ATC and AC both are the same, okay? ATC, AC, both are the same. APL is related to AVC, not to ATC or AC. So here you see APL rises. When APL rises, AVC falls. And when APL is maximum, AVC is minimum. And then APL falls over that range, AVC rises. AVC rises. We can show it in the graph like this. This is APL. This is where APL is maximum. At the same time, APL is equal to MPL at this point. This is AVC. The corresponding level of output. AVC is minimum. And at the same point, AVC is equal to MC. Okay. That is about the short run product, short run cost concept. Now we come to the point where, come to the section where we discuss long run cost concept. As you told at the very beginning, as I told you at the very beginning, all costs in the long run are variable. All costs in the long run are variable. So long run total cost, it's obviously depends on Q. Obviously, long run costs depend on Q. Long run total cost depends on output or the number of units produced. Long run average cost is total long run total cost divided by Q. Long run marginal cost is change in long run total cost divided by change in Q. They are almost the same. There is no cost concept called TFC. There is no cost concept called TFC in the long run. So long run average cost is long run total cost divided by output. Long run marginal cost is long run total cost, change in long run total cost divided by change in Q. We observe a pattern like this. So there is no fixed cost. There is no any fixed cost. Long run total cost take the same shape. Initially increases at a decreasing rate and then increases at an increasing rate. So cost begins at the origin. Q total cost. That is the rupee amount. This is long run total cost. At this point, long run marginal cost is minimum. At this point, long run average cost is minimum. This is where the tangent line and this is where the tangent line is the flattest. This is where the straight line is the flattest. And also at this point, both the tangent line and the straight line lie on each other. That is why at that point, long run marginal cost and long run average cost are equal. The relationships are almost the same, but the only difference is there is no fixed cost. And also this long run total cost is derived from this expansion path. We learned this expansion path in long run production theory. So these straight lines are isocost curves. These convex to the origin curves are isocon curves. Isocon curves. So when isocos curves are isocon curves are tangent, these are the maximum production levels. Maximum production levels that can be produced under the given cost. So with $80, we can produce one output. With $100, we can produce two outputs. 2 units of output. With $120, we can produce 4 units of output. With $180, we can produce 5 units of output. With $300, we can produce 6 units of output. So by combining these efficient production points, we draw the expansion path in the long run. And the corresponding cost values, 80 to produce 1 unit. Produce 1 unit, cost is 80. To produce 2 units, the cost is 100. To produce 4 units, the cost is 120. To produce 5 units, the cost is 180. To produce 6 units, the cost is 300. So these cost and output combinations are summarized by the total cost curve. These Q and C combinations are summarized by this total cost curve. When output is 1, cost is 80. When output is 1, cost is 80. When output is 2, cost is 100. When output is 4, cost is 120. When output is 6, cost is 300. So this total cost curve is derived based on the cost information provided by the expansion path. Expansion path shows how the firm can expand its production at efficient input combinations, with optimum input combinations. So these points represent optimum input combinations. If we take cost and output details provided by this expansion path into a table like this, if you take cost and output details provided by this expansion path into a table like this, you can easily derive the total cost curve. And this is about long run average cost. We talk some additional thing about long run average cost curve. We are going to discuss an additional thing about long run average cost curve in the next slide. This is it. This long run average cost curve. Long run average cost curve combines short run average cost curves. Long run average cost curve combines short run average cost curves. The average cost means short run total average cost. Short run PAC, total average cost, or AC, both mean the same. Total average cost or average cost, both mean the same thing. Because every time a firm operates in the short run, all the time a firm operates in the short run. So if we think about this particular point in time, SAB is operating in the short run. When it plans for expansions, when it plans for long run expansions, then that time horizon is called the long run. So every time when we observe the operations of a firm, it operates in the short run. It always operates in the short run. But the long run time or the planning horizon, long run planning horizon is called the long run. Long term planning horizon is called the long term. If SAB plans to establish a branch in Kandy, then that decision belongs to the long run. That will happen in a couple of years, maybe in 2028. We don't know. That time horizon is called the long run. Long run. Planning for expansions. In long run, what happens is the firm plans for expansion. But all the time, a firm operates in the short run. That is why long run cost curve, average cost curve, is a combination of short run average cost curves. So this is the short run average cost curve, the first one. This belongs to scale 1. The current scale, maybe. The current scale. This is short run average cost curve for scale 2. That may be in the short run average cost after the next expansion. This is scale 3. Short run average cost curve for scale 3. That is after the second next expansion. This is short run average cost curve for scale 4. That may be the short run average cost curve after the next 3, the third next scale, third next expansion. This is the current scale. This is after the expansion 1. This is after the expansion 2. This is after the expansion 3. Expansions means they increase their full capacity. If SAP establishes a branch in Kandy, that means they have expanded their business. If a garment factory establishes their factory, one of the factories in Bangladesh, then it's an expansion. So this is a zoom out, a zoom in picture. We have zoom in the picture. This is the complete picture. We have different short-run average cost curves for different scales. Scale 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. For each scale, we have a short-run average cost curve. For each scale, we have a short-run average cost curve. By combining those short-run average cost curves, we can derive the long-run average cost curve. Like this. This is long-run average cost curve. We combine short-run average cost curve using an envelope curve. Using an envelope curve. That envelope curve becomes the long run average cost curve. These are the minimum points of short run average cost curve. Short run average cost curve 1, short run average cost curve 2, short run average cost curve 3, short run average cost curve 4, short run average cost curve 5, short run average cost curve 6. They are for 6 different scales. They are for 6 different scales. The long run average cost curve. Let's derive long run average cost curve. Long run average cost curve touches short run average cost curves in their decreasing part. In their decreasing part. They don't touch their minimum points. Is long run average cost curve. Long run average cost curve touches the short run average cost curves in their decreasing parts. In their decreasing parts. So this is the decreasing part. This is the decreasing part. This is decreasing part. That is the initial behavior. And in this point, long run average cost curve touches the minimum point of A, the SAC for short run average cost curve. This is the plant. This is the SAC in the scale. This is the minimum scale, the short run average cost. The minimum short run average cost. So the scale is it represents the scale with which short run average cost will be the minimum. So compared to all scales, compared to each and every scale, this scale has the minimum short-run average cost curve. So before touching that point by LAC, before LAC touches that point, LAC touches SACs in their decreasing parts. And at this point, LAC touches, LAC. Touches SAC at the minimum point. After that, LAC starts to increase and touches their increasing parts. Touches their increasing parts. LAC touches SACs in their increasing parts. These are the increasing parts. These are the increasing parts. That is how long-run average cost and short-run average cost curves are related. So if you draw a graph like this, Q will be here. P values are here. This P. Over this range, the firm experiences economies of scale. When long-run average cost curve is decreasing, the firm is experiencing economies of scale. When the long-run average cost curve is increasing, the firm is experiencing diseconomies of scale. When long-run average cost curve is decreasing, the firm is experiencing economies of scale. When the long-run average cost curve is increasing, the firm is facing diseconomies of scale. So if someone asks from you, why the long run average cost curve is decreasing? The reason is economies of scale. If someone asking you why the long run average cost curve is increasing, the reason is economies of scale. So the reasons for the behavior of long run average cost curve. Reasons for the behavior of long run average cost curve are economies and diseconomies of scale. Long run average cost curve decreases because of economies of scale. Long run average cost curve increases because of diseconomies of scale. So we will learn what are the economies of scale and diseconomies of scale in the next session. Any questions? We will have a quiz that will be the midterm quiz in the second next class, okay? Not next week. Week after the next week, we will have a quiz from the content covered in the first 4 sessions. We already passed 2 sessions. This is the 3rd session. And next week, we will cover the 4th session. So based on the content covered in those 4 sessions, we will have a quiz in the 5th class. Okay? Based on the first 4 classes, we will have a quiz in the 5th class. So I will publish that news as a post on the LMS, and also I have to get a clarification from the administration house in which mode we can have the quiz. It should be a physical one or an online one. So after clarifying with it about it, I will post the notice. For the moment, just know that we will have a quiz on the 5th week based on the content covered in the first 4 classes. Thank you so much.